In this episode, we will correct the 3 most common misconceptions about infinite banking so that you can build your banking system with clarity and confidence. She's Holly, and she helps people find financial freedom.
He's Nate. He makes sense out of money. This is Dollars and Nonsense. If you follow the herd, you will be slaughtered.
All right, so today we're here talking about infinite banking, and Holly and I were just talking earlier. We get the same questions over and over again, or we find the same issues when people try to get started with infinite banking, things that come up all the time. So we wanted to make a podcast with just these 3 areas where we feel like many people are confused or misguided, or they've heard something, and some of them are from the infinite banking world that we've probably made an impression that might not be true, and others they might be hearing from some blog article somewhere that has told them something that's just not true as well. So we're trying to cut through the weeds, give you guys some confidence and clarity of what this really is, and we're going to discuss the 3 areas where we find the most misconceptions.
The reason we want to do that is so you guys understand from the beginning, or if you're in the process or in the middle, what really is going on, and try and be as forthright as we can. But also, one of the biggest things we see is the belief that somebody has this idea in their head, and then they go and do that, and it doesn't work the way they thought it would because of the misconception they had, because they never verbalized that misconception or asked the question, or if they did, it was after they'd already done it.
I mean, if you believe something that's not actually true, that means you can do things that might not actually benefit you. They may actually hurt you most of the time. So we're trying to help you not be hurt by some misunderstandings. And the first misconception is probably a multi-part one, because we're going to talk about, there's a few misconceptions about the loan system. So when we talk about policies and using them through a policy loan, it's a unique transaction that we're just not used to. So we can come in with some ideas of how it's going to work and what it does that may or may not be true. So the first misconception is going to have to deal with the loan process with policies. And we're going to talk about the interest part. There's a common misconception out there about what's going on with this interest.
Well, I think first that is like, I'm going to pay this interest because it is a loan. So there is interest due on the loan, unless you get a 0%, but no insurance company is loaning you at 0%, just like most banks do not loan at 0%.
It's hard to stay in business
It's hard to stay in
money.
business if you have 0%. And the misconception is that when you pay this interest, it goes directly to yourself. You're paying yourself the interest, and that is not true. You are actually paying the insurance company the interest. The insurance company loans you the money, therefore you're paying the interest to the insurance company. And so I think that people often think, even some where the misconception comes into, well, if I borrow from my 401k and I pay it back, the interest goes into my 401k. That is true. It is not true of the policy. The money doesn't go to yourself. However, it does go to the insurance company, and then you can receive that in the form of dividend.
We have 2 ways we buy things. We either borrow somebody else's money, we pay them interest, or we pay cash for something and we lose any interest our money could have earned.
Yes.
You got it? And so as Holly was saying with the 401k, many times when you take a 401k loan, they don't let your money stay in the stock market and grow for you, hopefully grow. I mean, that could be up for debate. But yes, regardless, they put it out of the stock market, so the interest you pay is getting deposited, but your money's not growing the entire time. There's a reason why the insurance company charges interest on a policy. It's not just they want to stick it to you. Remember, you're an owner of the company. They're here to benefit you. The magical thing you could say about a policy is that when we take the loan from the policy, the money inside the policy, the cash value never stops growing. It's going to grow at the same pace, compounded the entire time, still earn the same dividends. And essentially how this works, if I can make a clear picture, the insurance company is going to loan money to somebody. That's what they do. So your cash value is growing. They guarantee it's going to grow. They're going to pay you dividends they have for 150 years in a row type of thing. So they're going to pay dividends to the policyholders, and they're going to cause them to grow guaranteed from the very beginning. How do they do that? Well, they got to make money. They'll either lend the money out to somebody else or they'll lend it to you, but somebody is going to have to pay interest that makes them money so that they can credit the policy, the growth of it. So when we say, does the interest you pay go directly as a deposit into your policy? The answer is no. It's not just a dollar for dollar thing. Sometimes the interest you pay is less than what the interest of the policy is growing by. Sometimes it might be more. Maybe it depends on how old your policy is. If it's brand new, it hasn't really got started growing yet, probably not. But yeah, so the interest, that's a common misconception. When we say pay yourself back with interest, the honest truth is that it's not a deposit into the policy when we pay interest. It's what's causing the growth of it through them lending you money, you paying it back with interest, and that's how they can afford to keep compounding your policy. But it's not actually going directly into your policy.
And I think the key there, one of the things you should have heard is we automatically think the insurance company is out to get us. We've talked about this, the misconception that you're an owner in the company, you're a shareholder. So this benefits you. They're there to benefit you and help it grow. So the reason it is going back is because it is a loan. If you had a loan from a bank, you pay them the interest. Now, basically, as a shareholder, you are an owner in that company, but you are paying the company the interest.
And Nelson Nash talked about that. That's a great point. Yeah, Nelson Nash talks about that. We have to really see ourselves as owners of a bank, and we can't, if you've read his book, steal the peas. And what he means by that is most people, when they own something, they don't think they have to pay to receive it. So if you owned a third-party bank, you could take a loan out at 0% if you wanted to. You own the thing. I don't know how regulatory issues would come into play, but I guess you probably could. You give yourself favorable deals. And he's saying that's not a good business practice. I do agree there's a misconception. I get the question, how does the insurance company make money? And essentially it's like this thinking of they're out to get me. They're trying to make money off of me. What's in it for them? But in reality, the insurance company does make money. They make it in a lot of ways. The question is not how do they make money off of you. The question is the whole purpose of them being in business is to make money for you. You're an owner of the company. They have any money they make off of you. I'm using bunny ears if you can't see me. If any money they make off of you is profit that they send back to the policyholders. There's nowhere else for it to go. So that's what they have to do is make profit and send it back to the policyholders. So any interest they charge you, it's not like they're just trying to stick it to you. No, they're just trying to be profitable enterprise to profit everybody, including you. That's the whole point.
Their job is to be a business, and their job is to make money for you. Really, that's the bottom line, to pay death benefits and make money for you. That is the job of the insurance company because you're the shareholder, and all you had to do was buy a policy to become a shareholder.
That's the only way. Yeah.
That's the only way. It's not like you're in the stock market trying to figure it out. So point number one, the loan interest goes back to the actual insurance company.
Most stockholders, you buy stock in a company, you're not trying to think, if you buy stock in Walmart, we're not sitting here thinking, how is Walmart going to make money off of me after doing this? No, we're saying, we're focused on what are they doing to make money for me? And that's the whole focus. I'm the owner. I'm a part owner of this thing. I own stock. Now I want them to do business practice that's going to make money for me. The interest does not go directly to your policy, but it does benefit you as far as they have to lend it somewhere. They can lend to you or somebody else, but either way, someone's going to be paying interest. Your policy is going to grow the entire time, compound many times. It's going to compound by more than the interest you pay.
Have you ever wondered how to stop worrying and just make and keep more of your money? We believe in challenging the status quo. We believe in defying conventional wealth tools while maintaining traditional values. After all, most of those conventional tools only ever seem to make someone else on the inner circle rich. You can become debt-free, in control, secure, and achieve financial significance. Private family financing can be used in your life and even your business. Let us help set you free from worry. Visit livingwealth.com/freedom to receive your free copy of the Tree of Wealth. You'll learn about the tools banks themselves use and rarely speak about openly. These are the strategies used to launch Disney, JCPenney's, and countless successful families. For more than 46 years, Living Wealth has focused on treating clients with respect and honesty while helping them achieve financial freedom. Learn how to turn your hard work into significance. Visit livingwealth.com/freedom to instantly receive your free copy of the Tree of Wealth. You'll be enabled to have cash today and in the future. It's more than mere infinite banking. It's private family financing. Don't let banks and Wall Street dictate your financial future. Go to livingwealth.com/freedom to instantly receive your free copy of the Tree of Wealth. Now, back to Nate and Holly.
People think that it's the loan repayments that we make. So if I go out and borrow money from a car and I repay it with policy loans, they think that just by repaying the policy, that is what's causing the policy to grow. And the more loans I take, the more my policy is going to grow. Why is that a misconception, Holly? Why is that not exactly true?
Well, the misconception is that your money was growing, whether you borrowed it or somebody else borrowed it. It's principal you're paying back really on a loan. The only way the policy grows really is the premium is what drives the policy growth. It's like taking $100 and buying groceries at the grocery store, and then you eat the groceries and you gave the $100 back. They give you the $100 back and you go buy more groceries. Really, in reality, the $100 you gave them, you just got back and earned, and you gave them another $100. On a loan, it's the same thing. Whether it's $10,000, $20,000, $5,000, the principal just says, "Hey, you have $5,000 again to borrow." That's really all it says. The money was sitting there compounding year after year and growth. So it's the premium. It's what you actually are putting into the policy, not the loan repayments that's driving the growth.
Yeah, like we used to think, Ray will tell us this. This would have been early 2000s, 2002, 2003. Him and his clients were taking loans every month and paying them back every month and taking them out every month and paying them back every month. And they were just churning the money in and out because they thought the power was how many loans can I take and how much money can I send back in loan repayments. And then we get to the end of the year and he realizes his cash value is exactly where it should have been anyway. He didn't boost the cash value by making all these transactions. He calls it jumping through, mental gymnastics type of thing. What we're trying to say is the good news is that no matter how many loans you take, your policy is still going to grow as if all the amount was there. The loan itself does not limit the growth. It doesn't actually expand the growth either. The policy is going to continue to grow. But this misconception says I've got to pay my loans back really fast because the loan and getting the money back in is very important. What we're trying to do, and this is a suggestion to kind of weed through this with this understanding, but since loan repayments do not boost the policy faster, as Holly said, the only thing that boosts the policy faster is more premiums into it. Every time we pay a premium, we add new money to it. When we take a loan out and repay it, we're just replacing what we took out. So anytime we can add new money, that's important. So what Ray and I have done and Holly have done is we've said, why don't we expand the term of the loan? So instead of paying me back over 2 months or 12 months, what if I pay me back over 60 months? So now I don't have as much going back towards the loan. That means I've freed up money each month that I can pay towards my premium, maybe in a paid up additions rider, maybe a new policy. And now we have changed the policy. This also could be heard of as paying yourself extra interest. So you'll hear us talk about that too. If the insurance company has a 5% loan, we may pay it back at 10%. And that extra interest will boost the policy.
Yeah, because the extra interest is actually going as premium, paid up additions premium, to the policy, not to the insurance company. What's paid to the insurance company, the interest that they charge you is paid to them. The extra interest you pay is premium, and that is the only thing that drives growth in a policy is premium, not how many loans you can take out in a year and repay. And understand what Nate said in the terminology of extending the loan out. It only frees up cash for you to put into your policy to create more growth versus like, oh, I'm cash poor and asset rich, really, because we're trying to make it so that you're not cash poor and that the policy is continuing to grow and you're able to meet the terms and conditions of the loan you established.
I talk to a lot of people, especially people who don't start with us as far as being a client. They think that they're paying the premium, let's say it's a $10,000 a year premium they're contributing to their policy, and then they're just taking loans out and repaying it, taking loans back, and they do it really fast. And they think that they're practicing infinite banking just by taking loans back and repaying it. That's very important. We want you to treat it as a bank. However, you'll find if all you did was take out loans and repay it, 20 years down the road, all those loans and repayments, they're not driving more and more and more growth than what you would have been on anyway. So there's good news that we can take all the loans we want and the policy still grows the entire time. That's amazing. But we have to also be smart and say, well, if that's the case and the premium is what gets more growth, can I situate myself to extend loans, not repay them super fast, and add a little, maybe add $11,000 a year and reduce my loan repayments by $1,000 a year. And now we're like 20 years later and we are at a different level instead of a small level. So that first one had to do with all these misconceptions about loans and interest and how they work. The second one has to do with how long it takes for you to actually start using your policy. So Holly, what do we mean by that?
I've heard this a lot. I have to wait 5 years before I have cash value. I have to wait 5 years before I take a loan, or I have to wait 3 years before I can take a loan, that I'm just putting money premium into this policy, but I can't use it or access it. So that's a big misconception that people have, is that I start this life insurance policy, but it doesn't benefit me in any way in regards to taking a loan out or using that cash value until 5 years down the road.
Right.
And that just is not true at all. You might with a traditional policy that somebody would sell you traditionally, but it all goes back to the policy design. But you can have cash value immediately. And when I say immediately, we're talking a month, 2 months within starting a policy to be able to access that money and use it.
Exactly right. Not only that, so some people think, well, I've heard that I got to wait 3 or 4 years, so that's what I plan on doing. What if there's things we need to do right away? There may be 3 or 4 or 5 years of funding it before the policy really starts becoming very profitable, but that doesn't mean that we should just sit on the money and not use it. What if we have avenues to put it to work right away? Let's do it. So yeah, there's a misconception that it takes 5 years before I can even start using it. But then there's the other, like a pendulum swing. So there's that one side of the pendulum is it takes forever to use it, which is not true. Almost every one of our clients takes a loan in the first year they have it, in the first couple of months that they have a policy. That's through the GPS system we produce, and we'll show you by looking at what's going on financially, we'll show you. The other flip side is that there's other people who think that the policy is much more profitable than it is much sooner. In other words, they think that just by owning a policy, they could be a few years in and be extraordinarily wealthy. I get this, but people come in and they're like, wait, it takes me 5 years for it to really be growing by X amount or whatever. They think that it's a short-term thing, like it's a get rich quick scheme. This infinite banking thing, I can get super wealthy super fast. I don't know where that idea comes from, but infinite banking is a long-term focus. It's something that you are going to have with you as a banking tool hopefully till the day you die. That's how you benefit the most.
Well, and we even say, don't think of your policy or any policy as a 100-yard dash. Think of it as a marathon, that it's going to take 5, 6, 7, 8 years maybe, right, to really see this profit that you have. But would you invest that amount of time if you knew after 4 years or 5 years, nobody could get ahead of you for the next 20 years?
Exactly right.
I mean, I'm turning miles into years, but really, we are an instant gratification society. There's rules to doing this and to following and to being successful. But it's like Nate said, I don't understand how somebody says, I'm only putting $4,000 in, but why don't I have $20,000 to use? Like, it doesn't work that way. And I often say back to a client, do you know any investment that you put $4,000 in, 2 years down the road, you could pull 20 out?
So there's two sides to this. There's the side of, man, it's going to take me forever to use this thing. That is absolutely not true. But then the other side is, I should be profitable in my policy. It can take probably 5 to 8 years most of the time on a policy from how much you paid in equals the cash value. And why are we willing to wait that long? It's because life is not 5 years. I mean, if you plan on dying in 5 years, you should buy as much insurance as you can. But
you're going to beat the insurance company.
Beat the crap
that's
out of
for
the
sure.
insurance company. Yeah, that's the best way to bingo. But we believe that wealth is a lifelong pursuit. And we're not in it for what it produces in 5 years. We're in it for what it produces in 20 years and 30 years. And if you're not going to live for 20 years, the insurance company won't write you a policy if they think that. Because they expect, if they're going to write you a policy, they think you're going to live a long time. You're healthy enough to do that. So let's bet with them and let's plan for longevity for long-term, building as much wealth. Life, it's not a sprint. So there's two misconceptions that it's going to produce a ton of income right away, that we're able to, we'll make a huge amount of profit, which is not true. It takes time. Everything that's good takes time. People forget about that in this culture. This instant gratification culture. It takes time to build your bank, but it's so worth it once it's there. As Holly was saying, once you have a policy that's 5 years old, there's no going back. The thing is just making you more and more money each and every year, where you could be putting in $10,000 of premium in year 5 and pull out $15,000 of cash value for every. When are you going to want to stop doing that? Is it worth being behind schedule at the beginning to be able to make 50% on your money every year on your premium or something like that? So we can show you how to do that, but don't come in expecting it to make you incredibly wealthy a couple years into it.
And don't come into it expecting it's going to take forever to be able to take a loan out, that you can't use that money you've put in there for 5 years or even 3 years. Like, that's just not true. And so it really is in policy design, but there are people that say, oh, you got to wait 5 years.
No,
you don't.
Ask the thousands of clients that we've had to take a loan out in the first year and use it. So that's the second misconception. The third one is kind of the biggest one, that the hurdle that people run into, and it's a mentality. It's a misunderstanding, or it's a lack of change, where we call it the payment mentality. So the third misconception is that where, for whatever reason, people don't see the policy as a bank. No matter how much we tell you to see it as a banking tool where money goes in, money goes out, we still have this issue where every time we put money into it, we think of it as the form of a payment or a liability or an expense. And that can really weigh down your ability to build a good bank, because we see it in an incorrect light.
Nate said this even yesterday. It was so true. He said, basically, because the payment, the premium, came out of our bank account, we see it as we're worse off. We have less money. We're poorer. Instead of, in reality, you're actually going to be richer by making a premium payment. Not only death benefit, but the access to be able to use the cash that you're putting in there. Now, if it's relatively new, we're not necessarily saying, hey, it's dollar for dollar that you get back. Not true at all. But what we are saying is, if you stop that mentality, and my dad says this a lot, Ray says this, have you ever made too many deposits into your own bank account? None of us have ever made too many deposits into our own bank account. And if you view it as not as a premium payment, but as a premium deposit, that it's a deposit into your bank account. Yes, it left your bank account out here at one of your local banks, but it went into your own private family bank account, your life insurance policy that you get to control. And it actually made you wealthy. It made you more rich. It created generational wealth today and in the future.
And so instead of seeing the premium as this payment, see, every payment you've ever made, you've sent money to somebody and that money's gone, whether that's a car loan payment, a mortgage payment, or just simply utility bills or other insurance premiums.
Yeah.
Term insurance, car insurance, and whatnot. So whenever we make payments, we're so used to the money being gone. We don't like when money leaves the bank account, because that's where we are. Anything that leaves the bank account means I got less money. And we roll, unfortunately, subconsciously, we roll the policy into that. That's what breeds the questions, man, when can I stop paying this premium payment? You're saying that when I take money out of my policy, I have to pay myself back? We get these issues where we still throw the old world into the new world, and it keeps you very limited on what you can do if you see it that way. And as Holly was saying, I mean, maybe not the first 2 years when you pay a premium payment, your policy is not going to grow by more than you put in for the first couple of years. But by year 3, year 4, you could put in a $10,000 premium and have $12,000 of cash value. We have to stop seeing the premium as a payment. It's just moving money from one pocket to another.
Most of us typically have at least 1 or 2 bank accounts, whether it be a checking account and a savings account or something. All you literally are doing is taking it from one bank account and you're putting it to the other bank account. That bank account, though, is the life insurance company.
But yeah,
and that's your life insurance policy. No, the check is not made out to you, but you're the owner of that policy.
Instead of seeing it as a payment, the premiums and the loan repayments you make, any money that goes in, you cannot see as a payment. You have to say, okay, when I write this check, what's going to happen? Is the money going to be gone? How much is going to be available after I write it? This became very crystal clear. I have plenty of clients who come to me and they say, Nate, I've got life insurance policies that I've owned for 20 years, 30 years. And they'll come to me and they'll say, I want to get started with an IBC policy. Should I stop paying into this old policy? So let's say I have a $2,000 premium that I've been paying on this whole life insurance policy for 20 years. Should I stop paying it there to pay into an IBC policy? And the reason they ask the question is because they don't like paying into that policy. They think of it as a payment. They've never used the policy. That's the biggest issue, is that all they've done is send money to them. So it feels just like a payment that they're making. They got this life insurance payment. It's on the expense side of the budget. And what I always say is that might make sense. But first, we have to see, let's say I write a check for $2,000. What is that $2,000 going to produce? So then they go get what's called an in-force illustration from the insurance company, and they look at it, and for the first time, they see this $2,000 premium that they pay in creates $6,000 of cash value on this 20-year-old policy. They're like, what? I'm like, yeah, you're no longer making a premium payment. You're moving $2,000 out of a bank account into a policy, and it's going to produce $6,000 of cash value on this policy. Do you want to stop doing that? The answer is typically no. If you have this payment mentality going into life insurance, it's going to cause some problems because you're never going to really see the system for what it is. So you're not going to use it very much. You're going to have this, what we call poverty mentality, where you're going to say, what's the least amount I can put in? What's the least amount I can do? That's not a way to build wealth. That's why people are poor right now, because they want to say, what's the least amount I can put in and still make it in the future? What's the least amount? They're like, no, we've never made too many deposits.
And the least mentality only gets you a poverty mentality. I mean, it only creates poverty instead of what is the most I can put in and how much do I gain? Ray tells the story of his mom who would complain. She had a 30-year-old policy, but for the first 20 plus years or so, all she did was complain about the premium payment.
That her son sold her.
That her son sold her, right? This blankety blank premium payment, right? And then when she realized the growth of the policy, her entire mind shift changed to, why didn't you sell me a bigger policy? Why wasn't I putting more premium in there? So really understanding that this actually is an avenue for you. Or the other question that goes along with it is not the least, but when can I stop paying premium?
Right.
And I say to people when they ask me that, would you ever want your boss to stop paying you for your work? Would you ever want to stop writing yourself a paycheck? Paying yourself? No. Well, that's what you're doing when you're stopping your premium. You're not paying yourself, because if you're viewing it as a deposit, a bank wants as many deposits as it can get. In the same way, your policy, you should want as many deposits going in there as you can have available.
In other words, the question of how, is it possible to stop paying a premium? The answer is yes.
Yes.
Your policy can grow after you make it through a certain amount of time. You don't need to pay a premium, but normally when that question's asked, it's, man, I hate having to come up with the money to pay this stupid premium. When can I finally make it stop? I mean, if we get to year 7 in a policy and I say, yeah, you don't need to pay premiums anymore, but if you could put in this $10,000, they'll send you back $18,000. My question to you is, why would you want to? Typically, it's a misunderstanding. And we know that it's not a payment, but we think of it as a payment obligation. We also think that if we can't pay the full premium in any given year, that everything's going to explode and the policy can go, God, I'm going to lose all my money or something like that. It's way less stringent, way more flexible than most people realize. That can cause some of these problems. So education is typically the number one way. But if you can get rid of that misconception that the premium is a payment, an obligation that makes me poorer, or even the loan repayments I make are a payment, an obligation that makes me poorer, you're going to miss out. You have to see, when I make these contributions, what happens.
Absolutely.
And with that, I think we probably overwent our time. This has been Dollars and Nonsense. If you follow the herd, you will be slaughtered.
For free transcripts and resources, please visit livingwealth.com/E74.